While the world focused on holiday-thin markets and year-end price charts, the real event happened inside locked vaults and dealer warehouses. On Christmas Day, sales stopped. Not because demand vanished, but because inventory did. Screens still quoted prices. Paper claims still cleared. But the physical metal was no longer moving. What failed was not silver as an asset, but silver as a deliverable object. This was not a crash. There were no sirens, no headlines, no emergency sessions. The system functioned exactly as designed, until it reached a boundary it could not cross, a point where paper liquidity detached from physical availability, a point where arbitrage failed quietly, a point measured not in dollars, but in ounces. The halt was framed as temporary, operational, seasonal. But the mechanisms involved do not resolve on a calendar. They resolve only when inventory returns, or when rules change. This is not a story about speculation. It is a story about settlement, about margin, promises made against metal that must exist somewhere specific at a specific time, about what happens when that assumption breaks. The 209-ton pivot was not a price signal. It was a physical one, and once physical metal stops moving, the system does not rewind. It progresses, slowly, mechanically, toward exposure, escalation, and default risk. The screens suggested nothing was wrong. Price action was narrow. Volatility was compressed. Volume thinned as expected into the holiday window. Futures contracts rolled. ETFs rebalanced. Derivatives cleared. Every visible signal communicated continuity. Liquidity appeared intact because trades were still printing. And what the public saw was a market idling quietly. What actually happened was a market being hollowed out. On-screen liquidity is not the same as deliverable liquidity. During holiday conditions, price discovery does not disappear. It becomes shallow. Automated market making maintains quotes even as underlying participation withdraws. This creates the appearance of stability while reducing the system's ability to absorb stress. The divergence began there. Mechanism breakdown. The mechanism is simple and mechanical. A. Holiday liquidity reduces real participation. B. Arbitrageurs step back because delivery risk rises when inventories are tight. C. Paper claims continue trading without being tested by physical settlement. D. The screen price detaches from the dock. Arbitrage is the bridge between paper and physical. It only functions when metal can be sourced, financed, and delivered within known timeframes. As inventories tighten, that incentive collapses. No one steps in to close the gap, because doing so requires taking delivery risk onto a balance sheet. Liquidity is not removed by panic. It is removed by caution. Margin requirements remain unchanged at this stage, which matters. Stable margin tells participants that risk is low even as the underlying system becomes brittle. Institutional exposure grows quietly because positions remain open, rolled forward, and assumed safe. The analogy is a queue that still moves but no longer leads anywhere. People advance, tickets are valid. The door at the front is closed. Escalation ladder. At this stage, escalation is latent. There are no margin hikes yet, no halts, no rule changes, but the preconditions are forming. Low liquidity makes any future margin adjustment more destabilizing. Thin participation means any forced action will have outsized impact. This is the same structural vulnerability observed before the 2008 liquidity freeze, where markets appeared calm until funding evaporated overnight. The silence is the signal. Real-world signals. Away from the screens, signals diverged. Dealer premiums stopped compressing. In some cases, they widened despite flat prices. Delivery timelines extended quietly, framed as seasonal logistics rather than constraint. Inventory classifications showed subtle shifts. Eligible metal increased, while registered stock stagnated, indicating reluctance to commit metal for delivery. Industrial demand did not pause for holidays. It never does. The system still looked liquid, but it was already under stress. What appeared tradable was no longer truly deliverable. What visibly broke was simple. Sales stopped. Not everywhere. Not loudly, but across enough dealers to matter. Online listings vanished. Out of stock replaced prices. Phone orders were deferred. Delivery windows stretched, then closed. To the public, it looked operational, seasonal, temporary. What actually happened was an admission of absence. Metal could not be replaced at the quoted screen price within required settlement windows. Vault drawdowns accelerated while inbound supplies slowed. Wholesale bars were already allocated. Refinery output lagged, constrained by feedstock and scheduling. The dock went quiet while the screen kept talking. Paper claims continued to circulate. Physical metal did not. The causal chain is mechanical. A. Dealer inventory falls below operational thresholds. B. Replenishment requires paying above screen price or waiting beyond delivery guarantees. C. Arbitrage incentive disappears because margin cannot compensate for timing risk. D. Dealers halt sales to avoid creating new paper claims without physical backing. This is not a demand spike story. It is a replacement failure. Liquidity is removed not by fear, but by math. If metal cannot be sourced, financed, and delivered inside a known window, the transaction is no longer a trade. It is a liability. Margin pressure compounds the problem. Dealers hedge exposure through futures and forwards, but hedges assume physical availability. And when availability vanishes, hedges invert into risk. Institutional exposure concentrates immediately. Authorized participants, wholesalers, and short-term hedgers operate on just-in-time inventory. They are structurally sensitive to delays. The analogy is a bottleneck. The line keeps forming, but the opening narrows. Eventually, flow stops. This phase does not begin with rule changes. It begins with self-restraint. Sales halts are the first escalation step because they are voluntary and silent. They reduce future obligations before margin hikes force action. If margins rise later, as history suggests, they will do so into thinner liquidity, amplifying stress. The pattern rhymes. In 1980, silver rules changed only after physical pressure made delivery dangerous. In 2008, funding froze before prices collapsed. In 2022, the LME halted nickel only after settlement risk became existential. Halts precede rules. Rules precede force majeure. Each step increases stress by narrowing options. Once sales halt, price discovery loses its anchor. The screen remains active, but the dock is closed. The signals were present. Dealer premiums detached from spot, reported quietly in private quotes rather than listings. Delivery delays lengthened, first by days, then by weeks. Inventory reports showed eligible metal rising, while registered stocks failed to convert. Metal existed, but was not being offered for delivery. Industrial demand did not retreat. Contracts remained in force. Fabricators required metal regardless of screen conditions. The silence was the signal. Sales did not stop because demand fell. They stopped because supply could no longer pretend to be liquid. Nothing visibly broke on the screen. Prices still updated, contracts still cleared, ETFs still reported holdings. From the outside, the system appeared intact. What the public saw was continuity. What actually happened was duplication. The same ounces were being referenced multiple times across futures, unallocated accounts, swaps, and fund structures. This is normal until it isn't. The break occurred when claims multiplied faster than metal could move. Delivery became conditional, then optional, then rare. Paper kept circulating. Physical metal stopped responding. The causal chain here is structural. A, multiple paper instruments reference the same underlying metal. B, arbitrage is supposed to enforce balance through delivery. C, as vaults approach minimum operating levels, delivery becomes constrained. D, arbitrage collapses and paper supply decouples from physical reality. Arbitrage is not theoretical, it is logistical. It requires metal to be available, financed, transported, and accepted within a defined window. When any one of those steps fails, the incentive disappears. No participant steps in to correct price because correction requires taking physical risk. Liquidity does not vanish uniformly. It evacuates the physical layer first. Margin pressure accelerates the divergence. As spreads widen and volatility threatens, margin requirements rise. Not because price is unstable, but because settlement is uncertain. Institutions with leveraged exposure face a choice: post more collateral or reduce positions. Many choose reduction. They roll forward. They cash settle. They avoid delivery. Institutional exposure grows more dangerous precisely because it is invisible. Balance sheets still net out on paper. But the ability to convert claims into metal is mathematically implied to be insufficient. The analogy is a vacuum. Air still moves. Pressure equalizes locally. But once the seal breaks, flow becomes uncontrollable. This stage marks the transition from inconvenience to system stress. Margins rise selectively, not across the board, just enough to discourage delivery requests. Some contracts settle in cash by default, others extend timelines. These are framed as efficiency measures. History rhymes closely here. In 2008, collateral quality mattered more than quantity. In 2022, the LME learned that contracts without deliverability are unstable. In 1980, silver rules changed only after paper demand overwhelmed physical supply. Each escalation step removes another layer of optionality. Higher margins reduce participation. Reduced participation thins liquidity. Thinner liquidity makes halts more likely. Halts make rule changes inevitable. Force majeure is no longer theoretical at this stage. It becomes a clause under review. The signals sharpen. Dealer premiums become persistent, not episodic. They no longer compress when prices fall. Delivery delays normalize and are no longer explained away. Inventory reports show metal stranded in eligible categories, counted but not committed. Industrial demand continues to pull metal out of the system permanently. Those ounces do not return. The screen still shows a price. The dock shows a constraint. At this point, liquidity exists only where delivery is not required. What visibly broke was confidence inside the system. Not publicly, internally. Clearing members began reassessing exposure. Banks adjusted internal risk weightings. Some participants quietly reduced position size. Others stopped offering certain settlement options altogether. To the public, nothing appeared wrong. Contracts still traded, prices still cleared. What actually happened was defensive behavior spreading through institutions that understood the constraint. The screen still showed liquidity. The institutions supplying it were stepping back. A. Physical availability becomes uncertain at scale. B. Clearinghouses and banks reassess delivery risk, not price risk. C. Margin requirements increase selectively to discourage stress positions. D. Institutions reduce exposure or shift toward cash settlement. Arbitrage incentives collapse further under margin pressure. Even if metal can be sourced, the cost of holding exposure through delivery becomes prohibitive. Margin is no longer a buffer. It becomes a deterrent. Liquidity is removed by design. Institutional exposure is the critical vector here. Large participants cannot move quietly without consequence. Their withdrawal thins markets, increases spreads, and amplifies every future adjustment. Smaller participants feel this as volatility. Institutions feel it as fragility. The analogy is a margin call that never rings. Participants act preemptively, cutting risk before being forced. That collective caution drains liquidity faster than panic ever could. This phase historically precedes overt intervention. In 2008, margin changes cascaded through funding markets before Lehman collapsed. In 2022, nickel margins rose sharply just before the LME halt. In 1980, silver margins were raised repeatedly until longs were forced out. Margin hikes do not stabilize stressed systems. They concentrate stress. As margins rise, participation falls. As participation falls, any imbalance becomes harder to absorb. This makes halts more likely. Once halts occur, rule changes follow. Force majeure shifts from contingency to necessity. Each rung on the ladder reduces trust. Each reduction accelerates the next step. Signals became institutional. Bid-ask spreads widened even as prices remained calm. Dealer quotes became conditional. Subject to availability replaced firm offers. Delivery delays extended without explanation. Inventory classifications stagnated. Registered stocks failed to rise despite incentives. Industrial demand continued drawing metal away, unaffected by financial stress. Those flows are irreversible. The silence from institutions was not reassurance. It was preparation. At this stage, panic is not visible on the screen. It is embedded in balance sheets. What visibly broke was the contract, not its wording, its meaning. Exchanges continued operating. Clearing continued. Prices printed on schedule. To the public, the system appeared resilient, adaptive under stress. What actually happened was a quiet redefinition of obligation. Settlement terms softened. Optionality expanded. Cash alternatives were emphasized. Delivery language was clarified, then broadened. None of this was announced as an emergency. It was framed as flexibility. The screen still showed a price. The dock no longer guaranteed a transfer. The causal chain here is procedural. A. Persistent delivery stress threatens orderly settlement. B. Exchanges and clearinghouses prioritize continuity over conversion. C. Rules are adjusted to allow alternative fulfillment paths. D. Physical delivery becomes conditional rather than assumed. Arbitrage depends on enforceable settlement. Once delivery is optional, the arbitrage incentive collapses completely. There's no reason to correct divergence if correction cannot be completed. Liquidity remains in paper form because paper is infinite. Physical metal is not. Margin pressure continues, but its role changes. Margin no longer protects against volatility. It protects the system against delivery requests. Institutional exposure shifts from commodity risk to counterparty risk. Participants are no longer asking, "What is the price?" They are asking, "Will this settle as written?" The analogy is a queue where the service window announces substitutions. Tickets are honored, but not for what was ordered. This is the historical inflection point. In 1980, the introduction of liquidation-only rules marked the end of silver as a free market. In 2008, rule reinterpretation around collateral quality froze lending. In 2022, the LME's retroactive cancellations permanently altered trust in contract finality. Rule changes are never neutral. They redistribute risk. Once rules change under stress, they do not revert. Participants internalize the precedent. Future stress is met with faster withdrawal. Liquidity becomes fragile by memory. Force majeure now sits just beneath the surface. It no longer requires catastrophe, only continued strain. Each adjustment buys time. Each one costs credibility. Signals move fully off-screen. Dealer premiums decouple completely, trading in private channels. Delivery timelines are no longer quoted precisely. Inventory reports show metal technically present but economically unavailable. Eligible stocks rise. Registered stocks stagnate. Industrial demand continues removing metal permanently from circulation. Those ounces will not be rehypothecated. They will not return to vaults. The system still functions. But it no longer means what it says. At this stage, price is an output of rules, not reality. What visibly broke was participation, not trading, not pricing. Participation in delivery. Requests slowed, then stopped. Not because demand faded, but because an expectation changed. The public saw a market still open, still quoting, still clearing. What actually happened was a behavioral shift. Participants stopped treating contracts as pathways to metal. The dock remained constrained. The screen continued uninterrupted. Physical inventories stabilized at lower levels, not through replenishment, but through avoidance. Metal stopped leaving vaults because fewer actors believed it would be replaced. The system did not seize. It adapted downward. A. Physical inventories fall below levels required to support outstanding paper claims. B. Participants avoid delivery to prevent settlement uncertainty. C. Cash settlement becomes the default behavior, not the exception. D. Default risk migrates from hypothetical to structurally implied. Arbitrage is gone. There's no incentive to test the system when testing risks non-performance. Liquidity exists only where conversion is not required. Margin pressure no longer disciplines behavior. It codifies avoidance. Institutional exposure becomes asymmetric. Those who need metal face scarcity. Those who only need price exposure remain active. The system splits. The analogy is a vacuum forming at the base of the structure. Material remains above, but the support beneath it is gone. Collapse is not immediate. It is inevitable. At this stage, escalation is administrative. Margin hikes are fully normalized. Halts are ready tools. Rule changes are precedent-backed. Force majeure is no longer extraordinary. It is a risk management option. History offers no reversal here. In 1980, physical silver never returned to open settlement. In 2008, trust in funding markets took years to recover. In 2022, nickel contracts remained permanently repriced for credibility loss. Each prior step made this outcome more likely. Each choice reduced the cost of avoidance and increased the cost of confrontation. The latter ends not with a crash, but with disengagement. Dealer premiums persist, regardless of screen price. Delivery delays are indefinite rather than extended. Inventory reports show a stable but insufficient base. Metal present, but not mobilized. Eligible categories dominate. Registered stocks remain thin. Industrial demand continues removing ounces permanently. These flows are not financial. They do not reverse. The silence is complete now. The screen still offers numbers. The dock offers none. At this point, default risk does not require a trigger. It exists because the system no longer tests itself.